Hello everyone, this is your teacher Abdul Rafi, and today the topic of discussion is conceptual framework. So let's start with conceptual framework. So what is conceptual framework? Conceptual framework, as the name suggested, is the framework that lies with the concept. What are the main concepts of developing the standards? Okay. So about standard, we are talking about standard like IAS, and IFRS. So what should we keep in mind to develop these standards and to start working on these standards? So one thing that is very much important, that this conceptual framework is neither an IAS nor an IFRS. Conceptual framework itself is not a standard, but it will provide guidance how to develop a standard. Okay. Okay. So one thing that we should consider before starting anything, what is the objective behind the conceptual framework? So the importance of objective. So the conceptual framework objective is to provide useful information to users of the financial statement, and the second important objective is compliance with the laws and regulations. Okay. If you see, there are four highlighted words, that is information, users, financial statement, and compliance. Okay. Starting with the compliance, what should we keep in mind? Local laws, okay, then IAS and IFRS. So these are the laws, rules, okay, principles that we should need or that should be complied. Okay. So let me first tell you what is the difference between IAS and IFRS. Okay. IAS are basically international accounting standard, as well as IFRS are international financial reporting standards. Okay. Sometimes we can refer them as a rule based, and sometimes we can refer them as a principle based. But the main difference is that before 2001, there was an International Accounting Standard Committee, and any work done by the International Accounting Standard Committee was tagged as or labeled as IAS. In 2001, they developed a board, International Accounting Standard Board. The work done are labeled as IFRS. Okay. One more thing which is very important here, that it is sometimes we consider, I believe, is a misconception, that IFRS replaces the IAS. Okay. Sometimes it do replace the previous IAS. Sometimes it basically discuss a new concept which was never touched before. Okay. But there are cases when the IAS revised into IAS. Like let me give you an example of IAS 27. IAS 27, previously it was separate and consolidated financial statement. Now it is revised to IAS 27, that is separate financial statement. There is also IAS 28, which was previously investment in associate. Now it is revised to investment in associate and joint venture. So IFRS sometimes replace the IAS, but it's not always the case. Okay. So this is all about the compliance. Okay. So coming to the information, what is information? What is the difference between data and information? So data is not refined, but information is the refined form, is in refined form. So what are the qualitative characteristics of information? Basically, information should be accurate. So this is the qualitative characteristic of information. Information should be accurate, and from accurate we get accurate, that is precise, free from error, and biasness. Okay. So accurate, precise, free from error, and biasness. Then we have complete. The information should be complete. For example, if we are getting 1 year financial statement, it should cover all the transaction of that year. All the transaction of that year should be included in the financial statement. Okay. Cost beneficial. It means cost must not outweigh the benefit. It should always be less than the benefit obtained from getting the information. So cost beneficial is also there. Then we have user targeted. User targeted somewhat defined the relevant that influence the decision of the user. This is what we call a relevant. Then we have adoptable, which means coming from a reliable resource. Okay. Then timely. Information should be timely in order to for shareholders to get the benefit from that information. So it should be timely. If there is a large gap or huge amount of gap between the times or date, for example, the company is required to produce the year-end financial statement. That is, the year end is 31st December 2024, and they are producing that financial statement at 30th May 2025. So there is a huge gap. So the past situation does not reflect the current figures. Okay, so that is the main issue. Information should be timely and easy to understand, obviously. So one more thing, these are the relevant qualitative characteristic of financial statement. Well, sorry, this is the qualitative characteristic of the information, and from this, accurate, complete, and timely. This is the faithful representation. Okay, so these are the qualitative characteristics of the information. Okay, moving to the next highlighted word, which is users. So who are the users of financial statement? So first thing, we can also call them stakeholders. So they can also call them stakeholder. So who are the stakeholders? How can we define stakeholders? So a person who can affect or be affected by the financial statement, policies and operations from the operations and policies of the financial company are the stakeholders, or person who have any kind of stake interest in the company's financial performance are the stakeholders. There are a number of stakeholders. The most important stakeholders are shareholders, then obviously government and employees, okay, then customers, suppliers, and public, general public. So these are the number of stakeholders. Okay, so shareholders are the most important one because they have invested in the company. They are the owners of the company. Okay, why shareholders are interested? We are providing information to the users of financial statement. We will cover financial statement later. Okay, shareholders, they are interested in the equity because they want their investment to maximize. Okay, they are interested in profit, share price, in equity portion. Employees, basically they are interested in the performance of the company because they will be seeing what will be their position after 5 years or 2 years. So that is important. They will be looking at the stability, growth in the company, security, job security. Government, they are interested in the profit. Then ultimately they will levy the tax. Customers are also interested on the quality of the product company are manufacturing. Then suppliers interested in the cash position. Then there is general public. Okay, so these are the users of the financial statement. Okay, moving next to financial statement. What are the financial statement? What are the element of financial statement? Okay, so element of financial statement, there are 6 elements of financial statement. Okay, that is statement of profit and loss, statement of financial position, statement of cash flows, statement of changes in equity, notes, and comparative. Okay, for large company and medium-sized company, all these 6 elements needs to be prepared. There are exemptions to small companies. Small companies are not required to produce all the 6 elements. Okay, but for large company, public company, medium-sized company, all 6 elements of financial statement must be there. Okay, Starting from nodes, what are the nodes? Nodes can be divided into two categories, that is statement to the policy, and other nodes are disclosures. So what is the difference between statement to the policies and disclosure? Okay, statement to the policy. For example, if I'm stating I-16, International Accounting Standard 16, statement to the policy would be like property, plant, and equipment are carried at cost and are depreciated according to the statement method, right? This is the statement to the policy. On the other hand, disclosures. What are the disclosures? Disclosures are basically the working, because we know that if you if you ever seen the financial position, that is balance sheet, there is a one value. Okay, how that value has been calculated, it will be shown in the disclosure. There was brought down, there was addition, deletion, depreciation, revaluation, and the final figure carried out. So that carried on will be shown in the statement of financial position, but how that carried on being extracted, calculated is shown in the disclosure. In simple words, it is the working. Okay. Then we have comparative. In order to be useful, information should be comparable. For example, I told you that last year performance was okay. Let me tell you. This year, for example, the company make a revenue of 60 billion, for example, and you were excited that you all are excited that wow, that's a huge number. But let me tell you, last year the revenue was 80 billion. So this year the performance is net, although it is good, but not as good as compared to the last year. So comparative figures are also important. If you look at the audit report, you will find, for example, if you are looking at the audit report of the company or 2024 audit report of the company, you will find that there were 2023 data as well. Okay, so to make it comparable, to make users understand what are the performance, what is now the position of the company. Okay, so that's why comparative figures are important. Okay. Statement of profit and loss. Statement of profit and loss basically shows the performance of the company. Statement of financial position shows the strength of the company and the position of the company. Statement of cash flow shows the position of the cash. Okay. Statement of changes in equity shows how the equity has been changed from the last year to this year. Okay. Then we have these are the elements of income statement. These are the elements of statement of financial position, also known as balance sheet. These are the elements of the cash flow statement. So income and expenses. Incomes are basically increase or inflow of economic resources. Although expenses are decrease or outflow of the economic resources. You will never find any assets, liabilities, and capital in profit and loss, statement of profit and loss. And you will never find any income and expenses in statement of financial position. Income and expenses there is a place called statement of profit and loss for income and expenses, and there is a place called statement of financial position for assets, liabilities, and capital. Okay. Then inflow and outflow, all kind of inflows and outflows of cash flows will be reported in the statement of cash flow. We will look at the statement of changes in equity later in this lecture. Okay. So these are the element of financial statement. As you all are familiar with that, there are some principal rules which should be followed to prepare these financial statements. Okay. If you see that all the financial statement except for this are followed using accrual basis, because statement of cash flows are prepared according to cash basis. Other than cash flow, all statements are prepared on accrual basis. So what are the accrual basis? So we will be discussing the accounting principle. Okay, right? So accounting principles, first accrual basis, which means transaction must be recorded when it occurs. Should be recorded on it occurs. Okay. So what is transaction? Transaction is basically we call the exchange of interest, like purchase, sale, borrow, investment. These are all transactions. Okay. So it must be recorded when it occurs, whether or not cash paid or received. Okay. Then we have prudence. Also, we call a conservative approach. Plan for the worst, hope for the best. Okay. Um, we can also define it by that assets and income should not be overstated, liabilities and expenses should not be understated. And we can also define prudence like future losses should be recognized immediately, but future gains should not be recognized immediately. Okay. Then we have going concern. Going concern is also very important. It is the ability of the company to continue its foreseeable its operation for the foreseeable future. And for simplicity, we have decided that foreseeable future would be the next 1 year. Okay. If the company is not a going concern entity, then financial statement should be prepared on breakup basis, not a normal financial statement. We will discuss what is the breakup basis in a later lecture. Okay. Then we have matching concept. A matching concept is basically where income should match with the expenses. The common example of matching concept is how you depreciate your assets, non-current assets. Okay. If you are using straight line method, by using the straight line method used should reflect the economic benefit. If you are using reducing balance method, it should reflect the economic reality. Then we have materiality. Anything whose omission or misstatement could affect user is known as materiality. So these are the main accounting principles on which the financial statements are prepared. Okay, we have seen these elements of financial statement of each financial statement. So let's just stop on at that. So first, assets. What is asset? It is a resource that is controlled by an entity and from which future economic benefit will flow to that entity. One more thing, ownership is not there. Okay. Before this definition, previously there was also the ownership criteria, but because ownership does not apply to all assets, because if you discuss lease asset, we are failed to achieve the ownership criteria. So they have revised the definition of assets, and now the ownership criteria is not there. There are two main criteria. One is control, and the other one is future economic benefit. Look, the ISP is basically working on the conceptual framework, and they are trying to produce a universal definition for all the assets and liabilities. One definition, in simple one size fits all. They're trying to work on that. Okay, it is basically in a current issue. Okay, there's a hot working topic there. But for the time being, control and future economic benefit. So what is control? Let me tell you one thing. Humans cannot be an asset because we cannot control humans. You will not find any CEO or CFO or any other director in the financial position of the company. According to financial accounting, anything which can be controlled and from which future economic benefit will flow to the entity will be considered as an asset. We cannot control humans. Humans cannot be controlled. Why? How we can define control? Simply ability to sell. As we cannot sell our employees, okay, we cannot sell any human being because it is not legal. So that's why human beings are not considered as an asset according to financial accounting. Okay. Future economic benefit are the benefits that will eventually be quantified into monetary value. Then we have liability. Liabilities are present obligation as a result of past event, and settlement requires of economic resources and sometimes also a performer. For example, if you have promised someone to perform some part, that is also be recorded as your liability, like a deferred revenue. You are obliged to deliver goods or services in deferred revenue. Okay. Then equity, capital, also known as net assets. Okay. It is the amount invested in the business by the owner. Okay. Or sometimes we also define using this equation. Any residual amount of asset after deducting all the liabilities is net asset. Okay. We have assets can be divided into non-current assets and current assets. Liabilities can be divided into non-current liabilities and current liabilities. Okay. By current means time. Here the current represent the word current represent the time. Okay. Non-current assets will provide benefit for more than 12 months. That is one aim. And current assets, you will within 12 months you will able to get the benefit from that. Non-current liability will take allow you to more than 12 months to settle the liability, while the current liability don't allow you more than 12 months. Okay. Equity, there is no basically distinction between the non-current equity or current equity. As we know that we if someone started a business, definitely it's for long term. Okay. So we know that is equity is for long term. Any person who have invested in the business, who has started his business, its main purpose is to earn profit, and that to earn that profit for long term. So there is no current equity state. Okay. Okay. Then moving to the law of accounting. Okay. Law of accounting is very much familiar with the law of motion. Action and reaction. You have heard the Newton's third law of motion, that is every action has equal and opposite reaction, which is equal in magnitude but opposite direction. Okay. So let me tell you the law of double entry or accounting. For every debit, there is a credit, and for every credit, there is a debit. Okay. Which is equal in value but opposite in nature. Okay. So they should be debit and credit should be equal to each other. Although there is no universal definition to define debit or credit, you may have heard that what comes in, what goes out, but that doesn't apply to in all these situations. So the accountants had identified elements or items. Okay. So in simple words, debit, deal is debit and girls are credit. This is the simple mnemonic to understand what is debit. These are the items that are debit in nature, and these are the items which are credit in nature. Let me show you here. From deal we get drawing, expense, asset and loss. These are debit nature items. And from girl we get gain, income, revenue, liability and share capital. These are simple mnemonic words. Okay, that will be used in all financial accounting, and you must be strong in this double entry system, because there is no plus or minus in financial accounting. This is debit and credit. Okay, so these are the debit nature items and these are credit nature items. Okay, how it works now? If a debit nature item is increasing, apply the same nature. What is the nature of debit nature item? Debit. So if the assets are increasing, we need to debit them. If the assets are decreasing, we need to credit them. Okay. Similarly here, for credit nature item, increase means apply the same item, the same nature, and for decrease apply the opposite nature. So if the liability is increasing, credit them. If the liability is decreasing, debit them. Okay. This is how the journal double entry works. This is basically the rules. If the deals are increasing, debit them. If decreasing, credit them. If those are increasing, credit them. If decreasing, debit them. Okay. This is how double entry works. So let me tell you how this double entry system works. Okay. You may have seen in this lecture accounting equation. Accounting equation is basically A is equal to C plus M. Asset is equal to capital plus liability. Okay. If I tell you that I need you to calculate a drawing form for me by using this accounting equation, what will we do? D is equal to what? D is equal to A minus C plus L. D is equal to C plus L minus A, or D is equal to A minus C minus L. Which one is correct? This one. How? Law of double entry. Debit is equal to credit, right? Debit is equal to credit. So deal must be equal to girls, right? So if I eliminate only if I take only the balance sheet item, drawing is a balance sheet item, asset is a balance sheet item, liability is a balance sheet item, and share capital is the balance sheet item. So from this equation, D plus A is equal to C plus L. So drawing means D, C plus L minus A. Okay. So in simple word, if you want to calculate the expense, let's just move all the DAL to the other side of the equation. Okay. And you will get the E. Okay. This is how accounting works. Okay. You all have prepared statement of financial position and the statement of profit and loss, cash flows as well. Most of the times, students are not familiar with the statement of changes in equity. So let's just discuss the statement of changes in equity, how it works. Equity. If you see, equity is basically comprised of share capital, ordinary share capital, share premium, retained earning, reserve. This is a normal equity. Okay. We have some other reserves, but for the time being, let's just focus on the simple item or heads that are present in the equity. So you will find ordinary share capital, share premium, retained earning, and reserves in any of the financial position. So what is statement of changes in equity? Changes in equity means how this brought down is converted into this carry down. This is changes in equity. Okay. So let's just focus on this for share capital. Okay. First, for any equity, if there is a change in accounting policy treatment, we should apply first the IS 8 change in accounting policy to retain. Okay. First thing, if there is a change in accounting policy in that company. Okay. Let's just focus on the ordinary share capital and share premium. How these heads of the equity change. This can be changed by cash issue. This can be changed by bonus issue. This can be changed by right issue. So through cash issue, our ordinary share capital and share premium increase. To bonus issue, our share capital increase and share premium decrease, because bonus issue is basically like a dividend. You are giving free shares to shareholders using share related reserves. If you have share premium, use this. If you don't have share premium, use retained earnings. Okay. But keep one thing in mind, that bonus issue will always be done on coupon value, par value, face value, whatever you call it. Okay. Right issue. This is also to existing shareholder, and this will increase ordinary share capital and share premium. Profit and loss, how it affects or change the equity. Profit will increase your retained earning and loss will decrease your retained earning. Then we have revaluation surplus and deficit of IAS 16. Okay. So surplus and deficit will affect reserves and retained earning. And finally, the dividend. If you have declared or paid dividend, The dividend will be deducted or charged to retained earnings in statement of change in equity. So these are some changes that do affect the equity. So this is how statement of changes in equity are prepared. So this is your conceptual framework. We have there are some other concepts like current cost, market cost, fair value, okay, replacement cost, okay. So this is your conceptual framework chapter, and that's it from my side. Thank you.